so after these 3 startups that didn't go well,
but you learned a lot.
But I'm learning a ton.
Yep.
It was like I was getting like 3 MBAs back to back.
Yeah,
it
totally.
really was.
It's awesome. I can't recommend it enough. It's
I mean,
awesome.
At the thing, I probably learn more than I mean, you never stop learning, but if you take that approach. But I learned that set the foundation for me, just as a business person.
Mm-hmm.
And I wouldn't have got that level of insight or education essentially if I didn't take the accounting track.
Yeah. What's up, everybody? This is Mike Whitmire, co-founder, CEO of FloQast, inactive CPA, also now an active FloQast certified accountant. Check out our program around that. Welcome to our latest episode of Blood, Sweat, and Balance Sheets, the podcast where I like to find former accountants who have had really great career journeys and interview them about that path, understand the value of accounting and how it's played into their successful career journey there. So for today, I'm really excited for our guest, Brett Turner, the CEO of Trovata. Brett, welcome to Blood, Sweat, and Balance Sheets. So excited to have you here. I would love to kick it off with just, if you could introduce yourself.
Sure. Yeah. Thanks for having me. It's good to be here. So for me, this intersection of startups and this whole finance track, even also kind of going back to my earliest days as a CPA, has been a long one.
Yeah.
As you can see, got a fair amount of gray hair, and so lots of stories along the way. But yeah, it's so Trovata. We started the company about 9 years ago. Kind of we're in stealth for a couple of years. We launched our product. We've been in market for now about 6.5 years. And what Trovata is, trove of data. It's really built around bank data and infrastructure, and then really around building an entirely new experience, a next-gen experience to manage cash and liquidity. And so that's what it's all about. So if you think of the market today, pretty much anybody in finance who's touching cash or has access to the bank or managing the bank partnerships, from companies that maybe 5 to 10 million in annual revenue, all the way up to the largest companies in the world. So it might touch, the controller, maybe a little bit more on the CFO, or a full kind of treasury function. Managing cash, you're using bank portals and spreadsheets for a lot of folks. And then the largest companies are using what's called a treasury management system, where there's a lot of complexity managing things and a lot of banks. And so that whole gamut, that whole spectrum is what we cover. We're taking a kind of a fresh next-gen approach, all data-driven, and then it's building all of these features and functionality and experiences that kind of layer on top as part of that digital transformation journey.
And I know one of your strategies has been integrating with other partners. We are an integration partner as well. We offer some solutions that help with bank reconciliations. And so partnering with you all on the ability to integrate with banks and collect some of that data has been really awesome. I remember the first time I was getting to know you, we were investigating bank integrations and learning about like corporate accounts for small and enterprise, and it was so complicated. And then I met you, and the way you had approached solving the problem to me was really interesting. So want to take like a couple minutes to just talk about how you guys have approached the banks and how you've really built with them and partnered to be where you're at today.
Yeah, no, we love the partnership, with FloQast, obviously. And I think it would happen like in those days, it would happen earlier, but explaining why, I think you guys kind of learned why, is that this whole open banking concept has been around. That whole emerging movement has been around for a while, but it's mostly been, if you're in fintech circles, it's mostly been on more the consumer or retail side of the bank.
Yes.
And you have aggregators or other, Plaid is well known. You have Yodlee, MX, you have Finicity, and all those players are primarily on the consumer retail core. They do which gets confusing is because they do small business. But in the world of banking, most banks are still built off kind of some of them are on like still, mainframe systems. And it's retail, which is basically consumer and small business. I would say that more likened to, companies that maybe less than 5 million in revenue. So if you're definitely coffee shop, small business, you're going to be on more the retail or consumer platform. Once you kind of get to a certain scale, maybe 10 million in annual revenue and above, you can kind of still stay maybe on that consumer side, but you're starting to move into more of the corporate side of the banking, treasury services, and that's where it's on an entirely different platform for the bank. And that's where it gets really confusing, because if you think of it like, hey, you want to get access to, like with our partnership, bank data, you've got these aggregators that make it really easy, and they say, hey, we do business. We do small business. But then when you kind of get in and try to leverage them, it's like, why is this not working? And then, it's an entirely different deal when it comes on the enterprise side or mid-market companies, because they need the data. There's a lot more data. There's a lot more accounts, quality assurance, enterprise grade. All these things mean something to that space. And so kind of fortunately and unfortunately, I think it would have been nice if we didn't necessarily have to build that. But for us, it was strategic to our business. If we're going to build something around automation and a next-gen experience for bigger companies on that data, we were going to have to get our hands dirty. So we kind of had to go through this journey of really pioneering what became where the banks started building public-facing APIs. So we were the first company to build those APIs, and that's it's been kind of an area where we've built a lot. So it's been great because we have an expertise around that, but it hasn't been easy. These APIs aren't normal APIs. They're not like in tech circles. So I think that's where kind of that started to happen, and explaining that. And it doesn't seem very, you'd think it's like, well, it's an API, it should work. No. Well, it's welcome to the world of banking.
You are explaining my journey of like comical accuracy. It started with me using like mint.com and being like, oh, I just enter my credentials and it pulls in my bank account information. Why can't we do that for our customers? Like, oh, and then I literally that exact journey you went through, I arrived at, and then I realized, wow, we should really be partners because I'm very happy you did the work so that we don't have to go through all that. So it's been an awesome partnership. Now we are now deep in the weeds of a rather, I don't mean it in a bad way, but rather nerdy problem here is what we're talking about. So, and that's driven by a lot of your background. So let's shift over to kind of career pathing and what that's been like. I know you started your career as a CPA, so I'd love to maybe take it from the top and just tell me more about why did you major in accounting? What was your first role like? And then we can take it from there.
Yeah, it's cool because, you get to speak on the accounting side or to controllers, every single day. Those are your customers. That's your audience. It's not necessarily ours. Ours kind of goes through treasury, or maybe through accounting or finance, but that's maybe 20% of our customers. Typically, it's kind of through the treasury with bigger companies because that's where that banking relationship goes through. But yeah, I have a lot of, like, my early start. That was the whole track that I took. I started out as in auditing at Deloitte in the Seattle office. Got my CPA. Didn't last long in auditing though. I think
how long did you make it?
Just shy of 2 years.
Yeah, that's not terrible. I think that's average.
Yeah,
honestly,
I round up and say 2 years, but
I say 4.
Yeah, but I loved it. I think for me, it wasn't. I guess what maybe is sometimes a little bit of a blessing and the curse. Honestly, it's where there's part of me that's maybe this perfectionist, OCD. Maybe a little bit on the spectrum side of things, where it's that side. There's an aspect to accounting of just that detail-oriented aspect that appealed, and I liked it. It worked. And I think the other side, there was this creative side where I've always wanted to kind of run my own thing, run my own business. So where that mix comes in, I think I've kind of gone through that track, but maybe a little bit of a different way. So kind of what I pivoted in pretty quickly was in the late 90s, the dot-com era was going, the boom, the early wave of the internet, and so it was just startup central, in Seattle. And I think in those days too, aside from maybe Silicon Valley, in Seattle, there was, that's when companies were, if you had a .com and, you could go public and hardly any revenue. And so I think, but it was fascinating. It was just, so for me, I got a chance at an early age to kind of move into the startup world, being more of a junior executive on these teams where it was just fantastic learnings. I would say the first 3 startups, and a couple of them were actually fairly high profile. One was in an early e-commerce company. One was called Teledesic, which was basically way too ahead of its time, like an early Starlink, basically.
Oh, wow.
And they had a big, $1 billion capitalization with Craig McCaw and Bill Gates. So like some of these startups were it's just, but they didn't work out. And I think a couple of these too, I was the one who was sort of, turning the lights off on the way out the door. The board would kind of retain me. So even my family in those days would say, like, how are you finding success in failed companies? How does that work? But early on for me, I loved it because here I'm getting a chance to really learn how things work, how business works, and really kind of in some ways, kind of cutting my teeth on what it takes to build a company, to operate a company. And I saw that was part of it. I think the other part why accounting was so helpful, and I started at Deloitte, I got into it mainly because I had my brother was in finance, and then his wife was a CPA.
Okay.
And so she was the one who was employed, and he said, he's like, if you want a job out of school, go. And so thankfully I was able to work at Deloitte, and again, great learnings. You're kind of getting a chance. I think early on it was a chance to, like accounting, you're right in the the hub and the spoke of the wheel. You're getting a chance to see everything. And I think early on, because of this entrepreneurial bent, even what I was trying to do was how can I add a lot of value add? It's not just about, you know, the financial statements or even running process. All those things I kind of got into and felt like, you know, started to get those things kind of nailed. You have to do that. Those are table stakes. You got to do those well in terms of process and discipline. But I think this aspect of like, if I can build a data lake and I can get the data out of the ERP system, there's a lot of business intelligence there. There's a lot of insights that I can glean. And if I can get smarter about the business, then I could be an asset to other folks in the business. And I think when you look at it as an accountant, you're sitting on all of this valuable data. And if you can see the value of that data and what it can mean to other folks in the business, because a lot of the other executives, even, they're, for the most part, finance isn't their core, or they're, you know, to an extent, maybe
for sure,
you know, financial illiterate, you know, maybe not quite that. And companies, you have to have some sense.
I mean, in like the tech startup world, you have a lot of, and I mean, no offense by this, but a lot of engineers who have started these companies, and yeah, financial statements aren't their background. So oftentimes you are kind of got to be pretty 101 with some of it.
Yeah. And I think that what you learn early on too, if you're going to take that journey, which is what I loved, is that you have to be able to, it helps you sharpen your communication skills, because right away, if you're going to talk about something around finances, and this is why you kind of, you know, presentation when it comes to financials, but also like less is more. How do you teach something or talk about something in a very short soundbite without getting in the weeds? Because if you're already drawing on, you know, going on and on about something that you might be passionate about or pointing out a certain insight, you're going to lose your audience really quick.
Yes.
And so I think that's one thing, dealing with other non-financial stakeholders in the business. As I was kind of feeding them information, I was learning how to communicate that well, but also they're teaching me about how to do their functions. And so in a lot of ways, what helped set up, and so I was able to kind of scratch this entrepreneurial itch without necessarily starting my own company too early. And I think that helped me, just the basis of being, you know, learning about every position on the field in a lot of ways. So I'm learning a lot about, you know, what marketing is doing and what sales is doing, and spending a lot, you know, fulfillment and this whole kind of quote to cash cycle, you know, all the touch points within that. So I think that for me was, I loved it.
Within each of these companies, what was the role? What was your job title through all this?
Yeah, they were generally kind of controller roles. One was an accounting manager. And so it was,
and like roughly the size of the companies when you would have joined.
Yeah. And these were all, kind of generally in the, you know, in the 50 million annual revenue, 20 million annual revenue, kind of that.
So enough scale, you're seeing the business, but small to where you know everybody, and you can have a really big impact there.
It wasn't necessarily kind of, you know, hey, I've just met, you know, a couple of founders in the garage, and I'm coming in, right? There's enough scale, and so there's enough kind of, but it's still far from optimized. And so in some ways, sometimes that's the hardest, because you're seeing, you know, you've got the early traction, but then you're seeing now all of the issues of what it's going to take to actually scale the business. That's where a lot of businesses die, right?
Yeah, it's a whole different ballgame at that point. So the ability to communicate this information, I think, is really important for someone's career journey. So I want to just stay on that for a little bit longer. Any tangible advice you could give for, you know, you're a controller, how do you present numbers to the CEO or the board? What's a good way to condense it and make it a little more consumable for them?
Yeah, I think one is, you know, you're stepping outside your comfort zone. I think that's one. I think a lot of times you're getting good at your craft, and you take pride in that, and that's good. But I think then it's, do you stay in that lane, or are you going to now kind of, you know, leverage that to be able to kind of get that in the hands and get that, you know, that information out in the hands of other folks that it will really help. And I think sometimes there's, whether it's sales or operations, sometimes there can be a lot of friction with the finance team. And so if you can bridge, you know, that gap, and if you can feed information to those other stakeholders, that friction will melt away, which is kind of my experience, because now they're opening up. They don't see this adversarial relationship, like, okay, here comes Brett. He's going to, you know, bust me on the budget or something like that. There's actually clarifying things of like, hey, if we can make this change here or there, this could be more interesting. And if we could allocate more budget here, it's like, wait a second, you're actually helping me. You're being proactive and genuinely interested. And it's like, yeah, we're on the same team. So I think once those relationships starts to form, once that rapport starts to develop, it becomes valuable. But yeah, you've got to lean into it. And it's not maybe maybe against maybe your natural inclination, because like this is kind of the role.
Yeah.
But if you're willing to step outside of that, like anything in life, you're going to grow immensely, and the returns are just, infinitely higher.
That's a really good story. I feel like a lot of us, myself included, back in the day, guilty of sort of assuming others understand the numbers as well as you do. And so you'll present something and there are a lot of numbers on it. You're like, here's everything. And you have a room full of people who are kind of like, no, I don't need that. So then you learn to ultimately condense it down and try to simplify it a little bit. Now it sounds like you even took the next step where it's, let me condense it, simplify it, and then I'm going to take a look at it, see if I have thoughts, and then come with recommendations or something that starts a conversation with that budget owner. So it's not only easy to understand, but then you have something actionable coming out of it. Is that a fair summary? Yeah, that's really good.
From there, kind of the next level was, so after these 3 startups that didn't go well,
but you learned a lot.
But I'm learning a ton. Which was, so it was like I was getting like 3 MBAs back to back.
Yeah,
it really was.
It's awesome. I can't recommend it enough. It's
I mean, at the thing, I probably learned more than I mean, you never stop learning, but if you take that approach. But I learned that set the foundation for me, just as a business person. And so, and I wouldn't have got that level of insight or education essentially if I didn't take the accounting track.
Yeah. And in all fairness, part of it is startup world is you learn a lot because you're also working a lot. So if you believe in the 10,000 hours notion, it just takes you fewer years in startup land to get to 10,000.
It doesn't mean it's going to be pain-free. That's for sure. I think, you are living in dog years. So in some ways, not only have I been doing this for a while, I have gray hair, but it's probably lived like, fortunately, unfortunately, don't talk to my wife because it's maybe a little more painful, but it's like, you have to have a lot of support. You have to be willing to kind of lean in. And you do have to be passionate about it. And I think if that's what's going to drive it, it does make it, as hard as it is fun to be a part of that growth. So like after those 3, I actually was, needed a break. So I took a break from startups and went to work at Amazon. And corporate finance. This is back in 2004, 2005. And part of what I kind of thought is like, okay, even Amazon at that time was about $8 billion in annual revenue. Okay. So I thought, okay, I mean, obviously now they're massively.
He's doing well.
Yeah. I think it's when I left and which I'll tell you that next story, but left, I think the stock price is like $35. And it's like, well, you kept all your stock, right? It's like, well, no, I used it as a down payment on a house, of course, right?
Yeah, life happens.
Yeah,
life happens.
Exactly. But I think, I was kind of working on some sort of complex projects that they needed, but then also in return, because I wanted to, take a break, really ready to kind of move into more of a CFO role. Okay. And so I could kind of wait, and find the right opportunity, and but be there kind of at Amazon, and then also got to manage their SEC reporting. Okay. And so I was also learning a ton, and on that side of it, knowing that if I'm going to join a pre-IPO company, obviously that's going to be key. So lot of great experiences at Amazon. I love it. Met some amazing people. So it's still kind of. They've done really cool things as well. But then that call came in, and it was a CFO opportunity, and it was this company called Worldwide Packets. Okay. And it was a telecom company that had kind of an early start. The founder was one of the 2 inventors of Ethernet technology. Wow. As in like the Ethernet.
That's pretty wild. That's like a celebrity.
Totally. Like he was sort of very renowned in networking in that world. And but he started the company right around the .com bust. And so he'd put in like 30 million of his own money. Wow. He moved up from Silicon Valley because he grew up in Spokane, Washington. So I had a whole entourage of folks to kind of come up and be a part of this high profile startup. Okay. And it was one of these can't miss startups, even in those days, it had a, 200 pre-money, in its seed round.
Yeah.
Right?
No, that was a lot.
One of the top funds one of the top analysts in telecom left to join a big VC, and they raised $1 billion fund. At that time, they were the anchor VC in this company. So it had a really high profile start, but it hung on in those years for maybe four years or so until things kind of rallied back. I joined, thankfully this time around, on the other side when it was a bit of a turnaround, and Madrona, the VC in Seattle, led with a turnaround, kind of rebooting the company. I came in, there was kind of a newer executive team coming in, pivoted the business around more business services. And in that, so now going to this company, I've got a little bit of this playbook. I think that I've kind of figured some things out. First in as CFO, I go in my first probably 2 to 3 board meetings were a little rough. And it
Well,
was
middle of a turnaround. It's kind of okay.
because you kind of
Tell
know
us
where it's
more.
going. You got like original VCs who are maybe a little bit salty about getting, but they're having to pay to play. They're having to put money in, just kind of stay in the hunt. You got new VCs that are coming in, and so the whole board, there wasn't any independence. It was all financial investors, and everybody around the table it was all financial questions. It was all about where's cash utilization, capital efficiency, and so I'm bringing this, experience around financial reporting, this accounting background, and now it's, this playbook about leveraging all of this, the data lake and getting insights from the data. It was all predicated on the month-end close process, which gave a lot of confidence around all the numbers. But now they're asking questions. I couldn't wait, in arrears 45 days to get that information. So it's like, how am I've got to figure out. So I kind of went down this rabbit hole, and finally it was like it was kind of funny in these board meetings. They're asking questions around like AR days or just getting in the weeds on cash and collections and things like that. And some of I'm with our CEO, our head of sales, and COO, and they're kind of looking at me, and it's like, I thought you were smart, a finance person. How do you not know how to answer these questions? And it's hard to explain, but I know your audience would know. It's like, these aren't easy questions to answer on the fly. And they take a while before you can really, report on that metric. And so right then it was like, no matter how I explained it, it's a lose-lose scenario.
Yeah.
They're not going to give me 2 minutes to explain why.
The nuances of how this happens.
They're like, shut up. You're not going to be in the room if you don't figure this out. And so on the way out, I just said, okay, that's, in some ways, had a couple of, investor who might be grandstanding on a question too, because they knew it was a hard question to ask.
Okay.
And so they had a little bit of that going on too. So
can you explain that dynamic a little? Fortunately, I don't have to experience that too much. I've heard about it from other CEOs though. Yeah. Can you explain that kind of grandstanding notion a little bit?
Yeah. In the startup world, whether it's even internally, I think at the end of the day, when you're in a high performance company, and you're gravitating high caliber talent, just like it is maybe in athletics.
Yeah.
If you have people who are confident, there's probably a little bit of edge, maybe of like, you can't be arrogant, but it's like you got to be selfless and really confident and humble. And how do you get that? Not to be so. There's that edge. You kind of you're confident but not cocky.
Yeah.
And walking that. And I think in the same VC world, when you've got high performing VCs, they've been really successful. You're going to have, needless to say, you're going to have some level of ego around the table when you get all those dynamics in a boardroom.
Yeah.
And we had some really key investors in those dynamics. And so,
well, and you're also dealing with. Sorry to cut you off, but you're also dealing with a nuance that I want you to dig in a little bit deeper on this. You have earlier stage investors who, in at a different price, and then the business goes through, it sounds like a pivot here, and then you have new investors, and then there's not necessarily alignment, and you as an exec team kind of have to handle the different misalignments there. Would you mind just go diving a little deeper on where they're not aligned and what that's like?
If you kind of equate that to like a cap table, you had, I think about 75 million had come in. The original founder whose health was failing, he's now out.
Oh man, so it's extra tough. He's out of the okay.
Yep. And then you've got one of the earliest investors who's kind of a high profile individual, and some other high profile. They're all kind of high profile investors. Craig McCaw's personal investment company, they're in. So, and then you've got and they were the new investors, but the early investors with that 75 million that came in, 30 of it from the founder, all of that got basically flushed. Because it basically, they were going down a certain track more for consumer. We needed to pivot around businesses or on business services. And so, and the valuation at the time, was hundreds of millions. And that got written down to like, less than like a $10 million pre.
Oh man. Okay. So,
so it was a pretty big, it was a 50-to-1 reverse stock split.
Yeah.
Two reboots. So we're coming in though, without that baggage. But you've got, early investors who are carrying that and part of that. So you got to also understand those dynamics, and you got to be sensitive to that too.
Yeah.
But at the end of the day, they're all, you kind of have to write that off. You're kind of focusing on, but everybody's context and, IRR that starts to tick or calculate the moment they write that first check is all happening. And they all have a little bit different views or positions or, how they can kind of steer. So, so with that, then we, raised a new $25 million round, which, was a big round at the time. Now it's like a seed round. Right? So,
it is funny how things have changed.
Crazy. This is back in 2005. And so, so all of that said, it was all of those dynamics where we want to know where every dollar is going. And so, so I went down this. I told our team too. I said, okay, look, I'm gonna if it kills me, I am gonna build something that would be, we'll be able to answer all these questions, and it's really going to build up, a lot of credibility for our team along these lines. And so, it practically killed me, but I ended up kind of, in some ways, I'm doing the day job. Yeah. And then moonlighting on building what became more of this cash flow model. And it was basically looking at the tire. And this business actually was fairly complex because we were competing against Cisco and Juniper. These are the big, routing providers. And we were building a world-class switch in telecom in terms of for networking. And so the customers were Comcast or AT&T or so. It was a really, really technical product, but you're having offshore manufacturing of building that switch. It's predominantly the brains was the software, which is going to be on that chip. So you've got hardware components. You're dealing with, in order to get margin, you're dealing margin compression. You're dealing with like tooling that you're having to buy or make decisions whether you buy to get your COGS down. You're dealing with all the logistics, and then back in those days, so. Yeah, there was a lot of touch areas of gap that I had to, touch in those early days. But like one of them at the time, there wasn't good guidance on Rev Rec. And so if anybody remembers this story, like VSOE, remember that?
081, I know it too well. Yeah, yep.
Vendor specific objectives.
Yep. How do we allocate revenue across hardware versus software and then recognize it accordingly? It was the worst.
It was painful where we had so many elements where we had done this contract. It was a $30 million contract. We had collected about 90% of all the money. But because there was a support piece that was layered in there as part of the entire process of, shipping out the product, installing the product, providing the support, like we couldn't even recognize that 30 million until the very end of like what was like a 2-year process. So I think there's better guidance that's clarified a lot of that since, because I remember catching up with one of the partners at Deloitte who's still there.
Wasn't even, but you had to be recognizing it ratably over or there was a hang up in deferred revenue until the very end.
Now they fixed it with, I don't know. I
got my own gripes with ours.
Yeah. But there was a spot where it must've been around 2010 where they kind of cleaned that up and made revenue recognition. There was a new, now it's so changed since my days. But,
ASC 606. No, and we recently adopted that at FloQast, obviously, a couple of years ago. And I remember I put my like auditor argument hat back on and got in the room with the partner, and I disagreed with them, and ultimately I was right, so that makes me feel good with everything. But
still got it.
Still got it. RevRec's fun. It's super complicated, but it's super important. And then then you still have to then reconcile against cash because the RevRec is different than the.
I was going through those debates, and because I was at Amazon, I was one of the more technical, accountants, and on the finance team, there's me and this other guy that would tackle all the. So of course I'm, debating, and now we're bringing in, somebody in the national office at Deloitte as part of the audit, and then we sold the company, so that got caught up, the final audit prior to the sale. So there's a lot of stories around that, but that particular issue. So this whole aspect, because of that complexity, this quote to cash cycle was really difficult. And if you think of, even though we had raised, during the journey over the course of about 2 years, we raised about 65 million, which was a lot back then. Yeah. It still is a drop in the bucket. We spent 25 million roughly, or 27 million on building this world-class switch alone, and we're competing against Cisco, and they have, this war chest of money, right?
And they were like people don't realize they were like the NVIDIA of the time, right?
Yes.
Cisco was huge. Yep. I mean, So
the whole backbone of the internet is essentially Juniper and Cisco, routing products. And so with that is, that complexity is, so the amount of capital we have is a drop in the bucket. If we have to make sure every single dollar is going to be utilized if we're going to compete and make it. Because if we have to raise another big chunk of cash, I mean, that's going to be really dilutive, and you have all the dynamics you got to deal with that. So capital utilization was just hypersensitive. And so with that, So we ended up moonlighting, kind of building this model, and it took several months. But there's times too where it's a little bit of a, if you ask my wife, sort of scars because I'm coming home sometimes about 2, 3 in the morning, and I just get so obsessed. I'm like, I know this can be done. And what it was is essentially moving toward everything over to cash. So what I did is I just focused on experimenting with bank data. And this is about kind of a little bit of a segue of starting Trovata, is because, you kind of forget, as a CPA, you're focused on the indirect method cash flow statement because that's what you're publishing or you're reporting on at the SEC. But there's the direct method. And the direct method, if you kind of go back and brush that off and you kind of recollect, or some may use it and know it, but it's just cash on cash. Mm-hmm. You're not having to do with all of the timing differences or kind of reconciling back to your net income. Yeah. It's just basically opening cash, ending cash, and you're categorizing stuff down the middle. And so what I didn't know at the time, I felt like, okay, I go back, I'm literally kind of pulling at a couple of times, I'm pulling back the textbook, right?
Yeah, right.
How do I build that? And could I build that as a CFO? And if I could get bank data, and then so part of it is I had to reconcile all that back to to our ERP. I'd have my whole team involved in this later on after this was done. But once that was done, I could basically have cash transactions that were categorized functionally pretty well, maybe not perfectly but enough to really bucket the primary categories of where you care about. And that would allow me to see truly where cash could get stranded or have risk of getting hung up, whether it was logistics or some on the fulfillment side or the manufacturing side, or, because you're getting orders and we're having to take risk buys from maybe a channel partner. Mm-hmm. And then we've got to take risk on building the product because we couldn't recognize revenue ultimately until we shipped it. Mm-hmm. So all of these dynamics were coming in, and it's like, we can't be wrong. So how do we do that? Because this is impossible. Yeah. And so basically ended up kind of, felt like it was a bit of a cracking of the code, but a borderline kind of, borderline going into like the insanity moment. Right. I'm either going to solve this or I'm going to be in a insane asylum.
And are you like building this in an Excel model?
That's all
are you
Excel.
Writing code? Yeah, everything in Excel, right? So man, it's funny how you can, so you develop these things, figure out the Excel model, and then sounds like next step there is you ultimately figured it out, and then it led to your next move.
Well, and then working with different software engineers, at some point they're like, yeah, it's almost like you're starting to get really complex down certain areas of Excel where you're almost writing code. And And so, but anyway, sort of got that. And then the VCs loved it. They would want the model and say they'd have, CFOs or portfolio companies would be calling me and
you go.
Okay, you're making us look bad, but apparently you have this, secret model and you're supposed to, we want access to it. But at the end of the day, it's like, this isn't a product. Like, I'm not going to send this to you because it's not going to come with any instructions. I'm not going to be your product support person. Yeah. Like, this is terrible. Right? Oh yeah, it's really flattering, but also it's going to be a nightmare. So, but that in some ways kind of became part of this, in the CFO toolkit for me. That's how I just got better insights. It led to kind of building out our operating plan and all. So that was just kind of the way that helped me for, roughly a dozen years across 3 startups. Oh, okay. All 3 of those startups kind of, scale. So Worldwide Packets ended up selling, kind of had this last true exit in telecom. And that was awesome. And then that was the win, right? And so many things around the startup journey I'd learned through that. It was 3 years, but it felt like 20.
Yeah, that
and
must
all
have
the
been
learnings.
Awesome. Mm.
And so it was an awesome journey. And so I think with that, it opened up some opportunities to then finally start a company, and so ended up being a co-founder of a couple different. One was in energy, and then one was in cloud computing. That cloud computing company, we timed it really, really well. Timing does help sometimes. Yep. But we became the very first premier consulting partner to AWS when they started their enterprise program. Okay. And so the whole journey to the cloud was kind of our whole shtick, And so we got, it started with a friend of mine who is it was a friend of mine who's the specialist. He was the expert in all of this, but he started experimenting, with doing stuff in AWS before anybody was doing like real workloads. And so we started this company, and it was moving, a buddy of mine who was the local dentist, and said, okay, Tim, you've got those 2 servers in your back office closet, we're moving you to the cloud.
Okay. Nice. Yes.
Like, all right, you better not screw it up. I have no idea what that means. Mm-hmm. And so he was paying like an IT outsource company like $2,000 a month to maintain those servers. And we moved those into AWS. And that's back when they basically just had EC2 and S3. There wasn't a lot. And this is back kind of 2010-ish. And so, but the first bill, he just got it directly. It was the first bill. We just went through him. And it was like $19.67 or something like that. It's like, okay, another proof point. I think we got something.
So you saved the first dentist $2,000 a month.
Yeah.
That's pretty solid.
Yeah. Almost 2,000 to like, that was like 99.98% cost compression. Yeah. So we ended up, this business took off, good timing. Then we started getting on the radar of AWS and their program. And so they started bringing us in to some deals as well.
Okay.
And so we kind of had to, we knew that there were probably, if AWS wasn't doing it directly, there's, probably got some hair on it. And so, but yeah, we kind of proved ourselves with them. They brought us into this big project with Adobe.
Oh, cool.
They brought us into this, into Coca-Cola. So we moved the very first workloads of Coca-Cola into AWS. Mm-hmm. And then we ended up having like 3 badged employees at the Coca-Cola in Atlanta. So all this was super cool, and just learning about the cloud and how transforming it was. And so these segues of like this finance track, kind of this crazy discovering cash, and even this whole direct method cash flow statement, what I didn't know at the time was in the treasury world, that's called a treasury reconciliation. Or if you think about it, it's basically the construct of a bank statement.
Yeah.
Right.
Yeah.
So that these things all kind of transferred. I really didn't know, was really unlocking that stuff a little bit later. But after the company's second watch was the cloud company, it was at that point I really hadn't taken much of a break in a long time, and so I was able to kind of peel out a little bit early. The company was doing really well; it didn't need me, and so moved my family down to San Diego, and then it was kind of okay, take a little time off, and then
did you actually take time off?
I did take some.
Because earlier in the story you said I took some time off and started at Amazon, and I want to circle back on that. Did you actually take time off, or did you view Amazon as taking time off relative to startups? It
was funny because when I went to work at Amazon, I thought too, I'm still working a lot, but when you're working in the startup world, it can be endless. And so it feels like, hey, this is actually a normal job. This is easy. I can, so, but I think then too, that was genuinely like taking a break, spending time with family, recouping. And then it was really, am I going to do another startup or do something? And there was a few ideas, and one though that it kind of hung on is this whole, because we always talked about in Second Watch is it's all kind of digital transformation in cloud and IT, but eventually the final innings of cloud is going to be in financial services and banking. Mm-hmm. And so it's like, okay, well that I can't miss that. Like that's just right up, so even looking back, thinking it, some of the this cash flow model in Excel, like nobody had turned that into a product. And so it just felt like this whole, people would call when I'd kind of, so maybe I was taking some time off, but I was also kind of running this thesis at that time, running it to ground around, there's these large corporate, I was learning about large corporate treasury, the longtime treasurer of Amazon. He would tell me they were using this big legacy solution. Nobody really liked it. Nobody had built a new TMS in 20, 25 years. Mm-hmm. Now it's been almost 30 years. They're all antiquated. And it's for everybody else, it's bank portals and spreadsheet. Bank portals is like a website with hyperlinks and information. It's not a product. Mm-hmm. And the banks it's not in their DNA to really, they're not tech companies. So even though they build products, it's not like a product that we would think, like you've built with FloQast.
Yeah, it's not actual.
Yeah. Mm-hmm. And so maybe they would dispute that a little bit, but it's not like really, feature rich that you would need kind of as a company to utilize. So like, what about forecasting? That's been a bit of a holy grail for, it's not as much about the UI as people think it's kind of a UI problem. It's more about the underlying data. Mm-hmm. So all these aspects around like just getting better cash visibility. A lot of bigger companies are like, we have these systems, or maybe we're doing it through Excel, but just having, so all this really resonated. And the whole thesis was, if we could build a new experience, and people would say, oh, you're kind of building like a Mint for corporates, and sort of, there would have to be a lot more complexity on that user experience, but we're only going to build it if it's, because just learning the hard way, kind of going through these years, if we could build it on the foundation of data and more cloud native, going to use cloud, and that's going to allow us to iterate and be nimble with how everything is going to change. something that's ultimately, scalable that we could deploy in mass ultimately, but it's all going to be predicated on data.
Mhm.
And if we could build that on data and be really good at high performant data infrastructure, like we could build anything. And we could keep building features and functionality to satisfy what the market want. We'll listen to customers. And once we do that, then the marginal cost, whether we deploy or whether we, how we leverage that into a different feature, like that's going to be really, really small. It'll give us operating leverage to build off that that core. And that's essentially what we've done with Trovata.
And fair to assume you built on AWS?
Yes.
Yep. There you go.
Yeah.
Awesome. Yeah, they continue to be a great partner, I'm assuming.
Yeah, they've been fantastic. And I think the other, like Azure and Google Cloud, I mean, those are the other two, hyperscalers to call them now. But and they've got a lot of great web services and stuff too. So that has kind of leveled the playing field a lot. But in those days, even then, there just was a difference in terms of what was available, and I think they just become a great partner to build around.
So as your company's progressed, you started with the data layer. Let's get all that in from the banks, and then we can provide treasury management services on top of it.
Yeah.
How similar is it to that original workbook you built back in the day?
Any
of that transfer over?
Yeah, it's crazy because there's definitely some of that, but there's still some gap. And the reason for that is because I have a real passion for, smaller companies that have no chance of using tools or, being able to afford. You're still having to be very lean. I think it was in those days for me, and I think it's even worse in a lot of ways because I think what happened is the cloud actually kind of distorted the way of thinking for most finance professionals. Is because the IT journey got massive cost compression because of the cloud.
Yep.
So everybody was used to be running their own data center, raised floor. If you know those days, like lots of servers, you're patching servers.
I never had to deal with it, fortunately. So.
Yeah, and it was all about uptime. And so you had the IT administrator and a team of folks. They're just making sure all your services are up and running, right? And they're managing their own infrastructure. All that is gone. And all of it's now in a SKU, multiple SKUs with AWS, you're managing all through the cloud. But even in those days, it was like, okay, well, the cloud is going to replace all those jobs. Well, IT administrators just figure out how to become cloud architects. And instead of kind of playing defense, it's all about uptime, 5 nines. Now it's like you can turn the cloud into a real weapon. And so everything now is getting digitized. And so now we're kind of in these final links. So I think to answer your question, there's still this aspect of because we've had to go as a business, we've had to focus a little more upmarket. We've had to focus our sweet spot has been 100 million annual revenue to 3 billion.
Okay.
We do have some companies bigger than that, but they might be using a full treasury system, which there's a reason why nobody's built a new TMS in 25 years because it's really, really hard and really, really complex.
Yep.
And and when I looked at it, even to start building that, if we were to build it natively, nobody's ever gonna. It's not a venture model. No VC is ever going to fund that because my assessment was if you were to build out a full suite, it would take about 10 to 12 years and about $250 million. Like no VC is ever going to fund that in any kind of round. And you kind of have to have it all or nothing. And so you can't kind of leg your way into it because if you only have a small piece, you're just going to get eaten alive and you're never. So we've had to take an incremental approach in legging into that space, but that's why we had to focus more mid-market and small enterprise. But even on our forecasting solution, treasurers forecast things a little differently than more of on the business side or more of the accounting side. So even with our forecast now, I would say, and as you know, like forecast, it can be kind of, it's like talking religion or politics. It's like, it's very personal.
Yep.
It's like, this is how we forecast. This is how we do it. This is why I got the system. And I think so even then, sometimes you have to get people through maybe a little bit of a shift of a mindset on how to use it. So I think we're still going through that. I think that we have a pretty good forecasting solution, but I think also now, I think how that sort of ports down market, that's a big part of kind of where we're going now because the whole focus is we're gonna, as a business, where can we get kind of the biggest bang for the buck in terms of we're gonna invest a certain amount of capital and we're gonna sell to the market. We've got to we got to make those metrics work, right? So that's kind of where we focus, but still all along it's been we're going to use this and really go down market because we're really after the, really the online banking experience in a lot of ways. We want to make that product rich.
Okay.
And so one of the things that's our strategy has been, we've kind of had to build around APIs. So we've built the largest library of APIs now in corporate banking. It was kind of like working with FloQast is like, yeah, trust me, you don't want to do this. If you don't have to, we had to do it.
Mm-hmm.
But if you don't have to do so, let us, beat our head against the concrete.
It's like to just hammer on this for a second. It's like an API where you enter credentials and you're good to go with the SMB ones, and you're just like you're like consumer or small business ones. It's that easy to kind of integrate, so it's easy to start a company with that. At the commercial level, you are building relationships, getting to know people, going through security reviews. It's way more custom. It's not. It's just a lot more effort that goes into it. That's why, the gravity of the problem is really like way easier to partner with you guys than try to build on your own.
Yeah, no, it's been when you're dealing with customers that might have thousands of bank accounts.
Mm-hmm.
We have a customer that's got 14,000 bank accounts, active bank accounts. We have.
Is it across different? I mean, it's
across
different
banks. It's a well-known brand that you know, and just
so
they're huge, kind of in the healthcare world. We have Block is one of our biggest customers. We worked on early on that an early customer, and that's a lot of how we built a lot of our got a lot of our learnings around managing bank data is because they obviously have a lot of bank data as a payments company. So becoming kind of critical infrastructure for a lot of the stuff that they do, they use us to do a lot of their in-house reconciliation, where they've built multiple API or multiple apps off of our APIs. So a different application than like with FloQast, but they use that to do the same thing. It's like it's not strategic to get all that bank data aggregated, to get it all normalized, to transform it all, make it useful. Can we make it useful? And then you can take the baton from there and kind of build something that's more value added on top. We've built value added stuff on top of that ourselves, but also we're able to kind of make that available, for other use cases, like for the AutoRec product, which has been awesome. We love so I think this aspect of where do we go from here? I think, there's so many dynamics that are starting to happen, and maybe this is a good segue for like AI is now picking up steam. You've got stablecoins, which is new, but it's coming like a freight train. And that basically is on track to really reshaping the entire global financial system. So you've got these things that are now coming in terms of how they can change the way the bank functions, even in a lot of ways. And then you've got APIs, which was the start of it, basically making that data available. So we're kind of still, in a lot of ways, it's been a journey. It takes a long time to kind of innovate when you're in financial, working in the banking world. But we've kind of done a lot of the hard stuff and getting a lot of momentum and now operating leverage of being able to kind of start to build off of this, sort of data infrastructure core that we built.
Yeah. I want to dive in on stablecoins. How do you think that's going to impact things?
Well, it's funny because I think when AI came out, I mean, it was all about AI, and it still is, but stablecoins kind of quietly came in, and I think they've come in with a lot of skepticism because, many, even personally, have whether they bought Bitcoin or they've worked dabbled in crypto. Yeah. And so
a large number of people have purchased crypto. It's much more than I think the average person would realize. And
some people realize too, like how it does seem kind of crazy. They've been burned by it. You're reading books now about, people in jail because of the crypto 1.0, right?
There've been some grifts, man. Yep.
It's so you're talking about innovating outside of the core financial system. And I was just talking to a friend yesterday, and he's like, yeah, he went, he's going to buy he's kind of set up almost like a fund for his kid, and buy a Bitcoin, just sit on it, what I mean?
All right.
And his comment was too, it's like, yeah, once I was kind of going down that path to get it set up, I got hit up with 7 phishing scams, right?
Oh, interesting.
So there is some truth to that. Now I'll say stable coins has emerged that's completely different. And I think this is where it starts to get more utilized. So again, I think that the crypto journey is going to have its ups and downs. And I think to me, it's fascinating because it's all part of this is, it's not for the faint of heart, but also when you're innovating in startups, you're going to have some of these stops and starts. I think all those learnings keep getting better and better. And I think now with more clear regulation or regulatory clarity around You got companies that are emerging that are doing, like whether it's Coinbase or others, they're getting huge. Robinhood, digital assets, it's all coming. And I think it's in some ways living through like the internet 1.0 in the late 90s. That was really messy too.
Yeah.
But then all of a sudden you had emerging like Google and Facebook in 2004, 2005 that really took off. And you Stripe and these other companies that really leverage the internet in a very powerful way. And I think that's what we're seeing with crypto. You see now with stablecoins is sort of it's crypto, but it's different where it's it's a one-to-one relationship between, fiat currency or a US dollar. So if you had, and the one where it got on the radar that kind of surprised people, it became a bit of a tipping point in the industry, and that's Circle. So USDC is the second largest circulated stablecoin, and there's about 75 billion that's in that stablecoin now. And a lot of folks where it's got big use is that folks will be using in crypto, but when they want to get out and kind of sell out of their positions a bit, then where are you going to go into? Are you just going to go into US dollars? Well, you'll go into USDC because it's a digital dollar.
Okay.
So it's in a similar way, like if you're investing in stocks and you're saying, okay, I'm going to take some chips off the table. I'm going to invest and I'm going to allocate more in cash. It's a similar way to do it. And I think that's where stablecoins has been used as a digital dollar to do that. But now it's starting to get a lot more mainstream and starting to go down this path of being utilized for this digital dollar concept. And you're starting to get other, even banks are now, because of Circle, why it's a tipping point is because when they did their IPO, they 6 months ago, I think exactly 6 months ago, they had one of this meteoric rise in terms of one day. Their 1 day rise went up, I think, more than 10x. It was the most successful IPO, like where then you're like, you didn't price it right.
Yeah, there is a point.
How much money you leaving on the table there? Is that, the team.
Mm-hmm.
But I think that rise now, of course, it's come down a lot. I think it's come down maybe 2/3 of its value. It's come down. It's still quite a bit above its initial price, maybe 2-3 times.
They seem like a prime meme stonk candidate. Was there a bit of that driving if you're in the stablecoin blockchain? I wonder if that was hit Reddit at the same time as well.
Well, I think it's it maybe got a bit of that just because of its crazy meteoric rise, and then also now it's kind of fallen down to earth a bit. But
more reasonable. But
if you kind of still look at where they're at versus where they went out, I think they went out at $30. They're at $85.
Nice.
So that's still
that's really good.
If you probably said that in the outset, this is what would happen in 6 months, they'd probably be like, take that all day.
Oh, yeah.
Right?
If you hold that through the 6 month, no sale period and everything, you're good to go. That's a nice.
But then when you look at the journey, how to get there, though, then you're like, okay, what? But I think that therein kind of lies the intrigue, because then what was happening with that, then you got a lot of banks saying, well, we're going to, have our own stable coin. And because if you think of what a stable coin of a digital dollar is doing, and there are regulated companies that are blockchain infrastructure providers that are regulated, that are like US trust companies and whatnot. And so they go through a lot of the same scrutiny that banks do. But they've perfected they've gotten really good at the blockchain infrastructure of minting and burning and posting transactions on chain.
Mm-hmm.
And so now you've got this ecosystem that's really spooling up. And so now if you think of putting money into a stable coin, it's a bit of akin to like putting money into a bank account, opening up a bank account and putting money in it as a deposit. So then, where do you get yield off of it? Can you do things with it? Can you start to make cross-border payments? Can you make, intercompany payments? So there's a lot of use cases. And I think it's the promise of those kind of use cases start to get really, really exciting, because in a lot of ways, as much as it's all about trust with the banks, and that's the world that we live in. We work with the banks. We have, JP Morgan is our largest institutional investor. Wells Fargo is an investor. We have many banks on our cap table, a consortium of sorts. And so that's been our thing. We're going to build to these APIs. We're going to build this next-gen experience in ways that the banks haven't. But I think now when you kind of look at it, the banks also need to innovate. And now it's like you've got this with stable coins, you've got AI, where the banks need to go. And the banks typically get a little flat-footed in that. So they're sort of, APIs was a bit of opening up and conceding to, hey, letting innovation happen, like Trovata and others. But now it's like, is the cheese moving? I mean, there's this aspect of like, if we don't innovate now, we've got to keep up, because this is kind of where it's going. So I'm fascinated by it. I do think I mean, it's coming like a freight train. It's just in the last 6 months where, even for our own business, just looking where things were, even having, field testing and having conversations with customers then versus now, like it's now kind of coming even top down, like to treasurers. Now it's like I'm talking to a treasurer and they're saying, not because, hey, I'm really interested and looking at this, is almost like, yeah, I see a CEO and CFO want me to look into it. We need to research it. So I think these dynamics of basically around AI and stablecoins together are providing sort of this, this again, programmable money. You're hearing those terms. Those things are start to seem, and can be very real. I think we've got a little ways to go still on the corporate side. Like just like the data that there's got to be this, everything has to be consumable, or the way the enterprise can consume. So you're not going to have a company that says, okay, we're going to go outside of all of our core security and compliance and treasury policy, and we're going to get a Coinbase wallet and, send some money out of that to, some obscure place, and whatever. And so there's a reason why the financial system is such and regulated as such. So can you get the best of both worlds? Will those things align? And then this is why I'm excited with Trovata, is because now we can bring these technologies, we can bring AI, and we did this early on in a way that could meet the enterprise, or, their policy around AI governance. And now with stablecoins, we can do it in a way that's regulated, but also in the way where you manage your cash and liquidity. Where you do that? Do you want to do it outside in some shadow? You're not going to do that. It's too core. It's money. It's so you need to do that all kind of above board within the construct of your cash and liquidity system. And I think those are the things that are exciting, because that's essentially the path that we're on.
Well, and also it seems like, thinking through this as you're thinking through it on the fly, stablecoin moving into blockchain gives you a ledger system. You pair that with AI and unique ID ledgers, you have an opportunity to do some pretty cool stuff. I mean, just super high level.
Totally.
That's about as high level as it goes.
The wheels are. I mean, it is. It's why it's so exciting, because it's. I think now when you look at something like what the internet did, or even how AI is being so disruptive, and then on now, we're just kind of getting our sea legs in some ways on AI, or maybe depending on where you are in that journey. Some people are obviously well down the path, and that's great. But now stablecoins is coming really fast right on the top of that. So when it comes to, the whole financial services, the banking sector and all of that, you're getting, hit pretty hard to contend with AI.
Yeah.
And then now you got stablecoins that, and I think what the bank's concern is like, is there going to be a flight of deposits? Are deposits going to start to move in? Well, if you look at the what's projected with stablecoins right now, it's about 250 billion, but it's projected to go to 4 trillion by 2030.
Are banks not allowed to loan out as much against a stablecoin? I forget what the factoring rates are right now, but on a deposit, they can loan out 10x whatever is in the bank. Are the rules different for the stablecoin?
These are great questions, because it's part of your reserves and part of how they have to contend with that. So what's different
I'm
is,
sure FDIC hasn't contemplated it too much.
Yes.
Or I don't know. Tell me more. Sorry.
No, it's these are the right questions, because now it's like if you look at now just how a bank operates, you look at their net interest margin in terms of, that's one piece of it, but it's the ledger, it's credit, it's payments, and these are core utility components of what a bank does. They have to be ironclad. They have to be done, and then you've got the Fed. It's providing all that float and making it all work, right? Liquidity in the whole system and all of that. And so now when you've got everything starting to change, where it is under regulatory scrutiny, and you've got now with the whole regime change, and now you've got where, in the Biden administration, it was much more scrutinizing a lot of this, and then now we got the Trump administration. They're taking a more supportive view of all this, and now, hey, we want to make. Well, why are they doing that? Well, because they're also realizing that for stablecoins in particular, and this is what the Genius Act did to provide that regulatory clarity, is that that could be a really good thing for the U.S. government, because if you're going to use a currency, that's backed by US dollar, a lot of the reserves, the fiat reserves that sits to back it and collateralized, that's going to sit in that big pool, whether it's BNY or State Street, then, and that's going to get invested in US treasuries.
Right.
So now you've got, that's a big, if you can get all that kind of concentration, if you're the US government, then that's a good thing. So that's what's driving a lot of that.
We're going high level. It's a means of maintaining dollar dominance.
Yeah,
going
exactly.
forward effectively.
So you got these aspects about like, well, now there's more clarity. Now there's a little bit more incentive for that regulatory policy to change in that way. Stable coins are now on the rise because they weren't really that big of a thing. I mean, they were. Circle's been around. They've been doing this for a while. But I think now they're kind of becoming more accepted, seeing that as a mainstream means that's kind of on the heels of the kind of the wreckage of crypto 1.0 that's getting sort of reinvented. And I think now when you kind of look at what the bank, and so here's some stats. There's and I think again maybe challenge me a little bit on puts and takes on this, but generally there's about $12 trillion of global deposits on the corporate side that is non-interest bearing. That's $12 trillion. Wow. And banks generally you don't get interest on that. So when you're holding your money in bank accounts, you're not getting interest, you're getting earnings credits. So, and you negotiate that. So the banks, will give earnings credits. So it's whether it's 3% or 2%. But if it's right now the SOFR rate or the current overnight rate is Fed's rate is 4.02, or it's so 402 basis points. So there's that short-term earning on that. Now the banks can't maybe earn on all of that because they've got all these reserves and all the things they've got to contend with. But if you look at it from like a Circle perspective that's getting all this money into a stable coin, that money is on US treasuries and repos, and they're getting that kind of yield. And then, are they going to pass that yield on to the consumers? And right now, none of that is going to the consumers. Mm-hmm. And so it's being divvied up to the various infrastructure players and, Coinbase and others, for distribution. Okay. So now, and the bank looks at that because the banks like, okay, they typically don't have to give yield on those deposits because, and as you know, in companies, it's not about, it's liquidity is always first. You're not optimizing yield. Yep. Like you don't get fired if you miss out a few basis points on, you get fired if the money's not there when you need it.
Yes.
And so it's, liquidity, it's maybe utility, and then maybe it's yield. It's not that it's unimportant when you're sitting on a lot of cash. You need to optimize that. But usually in that sequence. So when you kind of look at this though, and you say, well, you get to a spot where can you get the best of all those worlds? Can you start to navigate where you have something that's going to allow you to save money on payments, where you're not having to spend transaction fees if you're moving money between wallets of two subsidiaries and you're moving a stable coin between the two? And if I'm holding some as float in a stable coin, and I'm getting a little bit of yield off that, I'm kind of doing a little bit of, your own banking in some ways. And so I think all of these things are kind of playing out that are fascinating. And I think when the banks look at it, they typically haven't had to pass on, they do in the earnings credits, and then earnings credits get used to pay bank fees. So if you've got a lot of bank fees, payment fees, et cetera, the company will use those. It's like your inside credits to, your in-store credit. If you made that exchange to Target, and it's like, can I get my $100 back for that sweater?
Yeah,
like,
there's something funny about that, but it makes sense. Okay, so it sounds like stable coins are going to have a big impact on banking. Sounds like a lot of question marks, but a lot of opportunity, and Trovata is going to be at the middle of it. Is it fair for me to assume you've carved out some engineering resources to figure out how to work with this?
Yeah, absolutely. Yeah. I think, and one thing about us too is like we see Trovata as a bit of a bridge between, it's called TradFi, more the traditional finance, because we're connected to the banks, we're building experience, we white label with the banks are our investors. So I think what's exciting about this, there's this new emerging stable coins. What is it? Where is it going? I think we're also really well positioned to not only do it in the right way for customers kind of consume and use it, but also in the way that can work well for banks to allow their customers to use it as well. So I think that it doesn't have to be like, well, it's just completely changing from the banks. There's a way to kind of navigate through that, even within the banking ecosystem. And I think we can be a key player to kind of help them through that as well and bridge that gap.
And you can be a competitive advantage for some of these banks to provide
absolutely.
A better experience. Well, man, I'm very impressed with your career path here, everything you're doing at Trovata. It's awesome. I'm very happy we're partnered again. I'll mention that one. maybe we can wrap it. A lot of people listen to the show for career advice and help with career pathing and understand how they can move up the ranks. Obviously, given your career, it's been awesome. If you would leave the audience with maybe a couple pieces of advice for how to take their time in accounting and what they've learned about accounting and finance and just help become a successful executive, I think that'd be awesome.
Yeah, no, it's like I say, I couldn't have learned all these things. And like once you learn something, it's sort of a springboard to learn the next thing. And that all started in accounting. I think you're sitting on so much valuable information, valuable data. And like, again, my career journey has been about data. And now Trovata is leveraging, that data in powerful ways. And I think that's just one is that, it's got to be comfortable being uncomfortable. I think that's a big part of, any kind of growth challenge. If you want to grow in life, you want to grow. So, and that's easier for some than others. But I think if you're willing to kind of step out of your comfort zone a little bit, if you're willing to kind of challenge yourself, know, hey, you're gonna be a little uncomfortable, but just kind of force yourself to do that. I think it just opens up these pathways of growth. And I think that's harder, I think, for finance folks or in treasury or in accounting, just because we're trained as risk is what we manage really, really well. And you get really good at that. And I think, but you can still understand what those things are from a risk perspective and still understand if you know where the fence is or where you've kind of that risk barrier can be, then go up to it. And you can be, you can do that with confidence, challenge yourself, grow in those ways. And once you do that, then it's pretty soon, I think you just start to develop, you realize that, hey, maybe there's those boundaries where I've kind of set for myself, or there's actually a lot further. Maybe it was just like 8 boundaries and I only saw the first one, but now that I'm kind of operating, there's actually a little less risk. I'm more comfortable and I'm more confident. And I think that just allows for a lot of growth and opportunities for everybody.
That's incredible advice. Could not agree more as well. Well, Brett, thank you so much for taking time today. This has been an awesome conversation. I'm sure the audience will find it very valuable. Thank you. I appreciate it.
Yeah, absolutely. Thanks for having me. And yeah, look forward to doing more exciting things with the Trovata FloQast partnership.
Of course, could not agree more.